So we are going to have our first panel right now about go fund yourself. What did you say? Go fund yourself. So how to plan for investment. We are going to discuss about startups that are looking for financing. Only a few of them actually manage to convince investors to give them money, especially venture capitalists. It's a lot of work, and I know a lot of startups that spend a lot of time researching and applying for investment. So I think this is a very valuable panel for an event like this. And I would like to invite on stage Daniel Lynch, Managing Partner at 3TS Capital, Rokas Tamaosiunas. See, we have a problem here because whenever you meet a person, you don't say, hello, I'm Anka Albu. You only say, I'm Anka, so I never know how to say the last names. Co-founder of Startup Highway. Hello, welcome.
Hi, I'm Rokas.
Hi. How do you say last name? Tamaosiunas.
Hi, guys.
Yes. Sitar Teli, from Managing Partner at Connect Ventures. And Jens Lapinski, Managing Director at TechStars. I obviously need the coffee break that's going to come up. There he is. Hello. Hi. And last but not least, the founder and CEO of Netokracija, Ivan Brezak Brkan, who will be our moderator for the day. So, yay. Can I have more excitement, please? Are we really that boring? Seriously. Okay, thank you and enjoy.
We get that mic or?
Yeah.
Hello. Oh, sorry. So I am Ivan Brezak Brkan, the founder of Netokracija, which is a tech blog that covers Central Eastern Europe and the Balkans in particular. First of all, I'd like my dear guests to say a few words about themselves so you get to know them. So please, Rokas, starting with you.
Hello. Hi, guys. I'm Rokas Tamaosiunas. As we found out, very hard to pronounce my last name. I run Startup Highway, an accelerator up in the Baltics and Lithuania. We invest in startups, we take them through startup acceleration, and we help them fund afterwards.
My name is Daniel Lynch. We run several different funds in venture capital technology businesses. We have a Romanian-only dedicated fund for early stage and Series A financings in Romania, as well as similar funds in Slovakia, Turkey, and Czech Republic. We also have a large fund for Series B financings for IT technology businesses for the entire region.
My name is Sitar Teli. I'm with Connect Ventures. We're based in London and we invest across Europe. We're primarily a seed stage investor. So we invest between 300,000 to 600,000 pounds in companies. We have investments, we have 20 investments now. So we've been pretty busy. It's a 3-year-old fund, and about half of them are in London, and the other half are in cities across Europe.
My name is Jens. I'm Managing Director at TechStars. We are one of the largest accelerators in the world. I think we currently have 14 or 15 offices, invest in about 150 to 200 startups per year, about $120,000 each. The vast majority of the offices are in the US. We've got 2 in the UK as well.
Cool, thanks guys. Okay, so the topic of the panel is how to make your startup investable, actually the subtitle being go fund yourself. And obviously most startups don't receive or don't secure funding. At what we're going to try to answer now is, again, how you guys can do it and also what you need to do to know before you start looking for an investment. So let's start with a basic question, but an important one. Do all startups, tech startups, need financing from you guys? And also at what point? And keep in mind, especially your experience with startups from Eastern Europe. What's your experience, and what would you advise these guys when to start financing if they should start looking for financing?
Well, maybe if I can just start. From our point of view, we don't invest in R&D. Okay, so it's important that people have a complete product and know what the market is and have an idea about when they raise money, how they're going to use it. It isn't just going to be for product development. It can be for product development because we need to see traction. We need to see the commercialization of the business and a monetization strategy. And for us, We don't do startups, we don't do pre-revenue companies. That we leave those for the angels and the earlier stage funds, but we do come in after that stage.
So specifically on the question of whether all companies should raise money, it's absolutely not. Venture capital is oftentimes called acceleration capital. And if you're not going to use the money to accelerate your business, then you shouldn't be raising it. A lot of times I'll see companies, particularly from this area actually, that want to raise venture capital money and then want to go from, say, 100K a year to 500K a year, which may seem like an acceleration, but it's really, really not. When you look at companies that are actually using capital to accelerate their business. So I think when you think about raising venture capital, you really have to think about what you're going to be using that venture capital for, and whether you're really going to leverage it to increase the pace with which you're building your business. And if you're not going to do that, you're not going to raise venture capital probably, because you're not going to be interesting to venture capital investors.
Sitar, can you give an example of a company that came to you, or not a specific example, but like a company that wouldn't get funding because they couldn't increase the pace, had the wrong pitch for you?
I'd say most companies I look at actually that have revenue, actually there's a kind of a peculiar effect of a lot of companies that bootstrap. They oftentimes, when they decide to raise venture capital money, they don't actually feel comfortable committing to going back to being unprofitable. And so they don't want to accelerate because they just want to grow quite organically and conservatively, even though they've taken on venture capital money. And so we see a lot of companies like that. You know, someone who goes from £1 million a year to £2 million the next year, that's just not very much growth in a company. It's great organic growth, but that's organic, and you really shouldn't be raising external money for it.
So, as a founder, you have to consider that you will be building multiple ventures in life. And some of them, most of them, will not be successful. And once you're onto a successful one, you're probably going to spend several years with it, maybe as long as 10 years or so. So it's in your best interest to figure out whether this is going places or not going places as fast as possible. And if it's going places, then it's in your interest to, take it places as fast as possible. So in that perspective, if capital is acceleration, you should always seek acceleration, and therefore you should always seek capital. However, it's not so that every time is a good time to fund. People come to investors and ask about all this stuff and so on, and typically they come when they're distressed. You should try and seek capital when you have a very good idea what to do with it next. So when you have when you've built the product and now you know how to scale your product and your business, you should go and try and seek funding. When you figure out what marketing works for you, and now it's just a question of how much money you put in your marketing, you should try and go and fund. But my view of things, if you want to spend your life on something meaningful, you should always try and seek and accelerate and therefore fund your business.
Jens, you want to weigh in?
I'm going to give a very simple sort of rule of thumb. So VCs want to invest in companies that within 5 years of their investment generate over $100 million in annual revenue. Right? Every company that doesn't do that is fundamentally disinteresting, as a rule of thumb. Right? So if you think that your company can generate $100 million of revenue in 5 years or more, preferably much more than that, preferably more like $1 billion in revenue, right? Then, I'm sure you would want to talk to VCs, and I'm sure all of the VCs will want to talk to you, right? But the vast majority of companies are not even remotely close to that. The second rule of thumb is if you're raising less than $5 million, I would strongly encourage you not to talk to VC funds, apart from Sitar. No, I mean, seriously, so the VC funds, funds that are larger than $100, $150 million, that sort of order of magnitude. Seed funds that are below that, and we're pre-seed funds, so that's completely different. But I would strongly encourage everybody, because, Connect Ventures and similar fund sizes have a tendency to co-invest a lot with angels, and effectively they're doing these seed stage rounds of, $500,000 to maybe $2 million or something like that. So I would strongly encourage you for that to be an angel-led process if that's the amount of money that you want to raise. Angels have completely different targets. So for them, a company that generates 10 million in annualized revenue is actually quite a meaningful outcome, right? And for seed stage funds as well. But for venture capital funds, like 100 million plus to $1 billion funds, that's a completely different order of magnitude. So that's how I think about it, and I'm quite sure that's how they think about it as well.
So let's say a company that thinks that they can make 100 million or more comes to you and wants to present or pitch what they're doing and what their vision for the future is, how would Jens, you specifically, but also everyone else, go around evaluating them? So what do you look for in startups when they come to you in order to look at them and say, okay, I'm going to invest in these guys or gals?
Yeah, I mean, I look at, I don't know, maybe 3,000 companies like that every year. So, I mean, the primary thing that I'm looking for is the absence of a flawed foundation, right? So we are looking, I mean, so there are two things that you can evaluate in early stage startups. You can evaluate the team and you can evaluate the market. If the team and how the company is governed and what the equity distribution looks like and a bunch of other stuff, if that is fundamentally flawed somehow, then the probability of this company taking off is incredibly small. So that is, in a sense, to the team, I mean, this is counterintuitive, but the team is actually a downside risk, right? Great teams don't make great companies, great market make great companies. So the team is all the risk, and then the market is all the upside. So you're basically looking for a market that's currently small, it's going to explode for some reason or the other, and that team can monopolize as much as possible, right? Very little competition, huge demand, enormous unit stats from the early tests that the company is running. That's sort of and then completely clean on the team side and on the structural side. That's sort of for me, that's the dream scenario, preferably 1 week after they've launched.
Cool. Daniel, did you want to weigh in?
No, it was very good.
Anyone else?
So I guess we have a different view on it because we invest at seed stage. So for us, we're really looking at team and product, right? And when we look at, we're quite product focused, right? So we look for companies that lead with product, and then, you know, marketing, even pricing, distribution is all kind of tied into the product and related to the product itself. And one of the reasons why we look at the product is not because we think the product is going to tell us something about the market, it's because the product tells us a lot about the founders, right? When you look at a product, you can tell a lot about whether founders respect their users or their customers. You can tell how much they respect user experience. You can tell if they understand what user experience is, or if they think it's the same thing as user interface, which a lot of founders do. So it tells you a lot about the founders themselves, and that'll tell you about how they build product in the future, because one thing we know for sure, whatever the product is when we invest, it will be fundamentally different even in 6 months, and then a year and 2 and 3 years from now. So really what we want to know is, how do the founders think? And you can't really ask people, how do you think about product? I mean, you can, but you're not going to get a good answer. So what you have to see is the reality of it. So how have they developed product over time? How do they think about it? What's their process? And what do they prioritize? And how quickly do they build? So we look a lot at that to varying degrees. Sometimes we meet a company and we can tell right away. Sometimes we have to spend a little bit of time with the founders.
So continuing actually on Jens' point about teams being a potential risk, or not teams, but some of the problems that they have, what are some of the other warning signs that set your alarms off? What do you see in a team or a startup that's like, oh God, this is not going to?
A very quick litmus test of senior management is, are they able to hire good people around them? Are they able to hire better people around them? And do they understand where the skills are and where they're not? Because we'll come into a presentation and we'll see, okay, they've got finance skills, they've got technical skills, but they're lacking in sales and marketing and channel and product. And they're also lacking in internationalization. So we try to go out and, together with our financing, find these people, these industry experts or senior managers, and bring them in as part of the transaction, and make our investment transformative in the business. And if you see a senior manager with a disproportionate amount of equity, overbearing in terms of their colleagues, that's not a sustainable management setup that's going to survive the stress test of going through the startup phases. And that's why the cohesion of the senior team is very, very important.
So we look for a couple of things at seed stage. One is, do the founders respect each other if there's more than one founder? Be amazed at the number of times the founder who's the CEO thinks their job is to answer every question, even the technical ones, which they don't know how to answer. And instead of trusting their founders, and founders that don't trust each other is just a really, really bad sign. And the other is, and this is because it's at seed, we always look at what they think their expenses are going to be. And one thing I look at is what they think their salaries are going to be. And founders that pay themselves quite a bit in the first 18 months of the life, before there's revenue, before there's sometimes even a product and users, to me is a really, really bad sign.
I'd like to second the colleagues, and for it to be a learning experience, bad cap tables or wrong shareholdership is definitely a very big problem with a lot of companies we see, and I guess all of us see. And that's not just, this proportion between the CEO and the lead founders, but are there, too many passive advisors, too many passive early stage investors and such? So is there enough people holding enough shares that is actually making value for the company and putting in the hard work? And surprisingly, how many of these early stage companies onboard a lot of people they don't really need or will not benefit in the later stage. Another thing that's always useful to keep in mind is do not focus locally. If you go to big investors, experienced investors, successful investors, and you speak about how long it's going to take to saturate your home market or how you're going to take local markets one by one, year by year, that's definitely going to put off the investor. You want to speak about how you're going to access the right markets and grow really big in reasonable amount of time. I suppose one other thing is we see a lot in early stage is when people come for money when they run out of money. You're supposed to come for money, as I said before, when you know what to do with it, not when we kind of burn through our petty cash and now we would like you to give us money so we can kind of extend our existence. The good guys come when they say, hey, we already have some traction and it's going on. But if you see people who are saying, we're not even going to start on the product before you're funding us, it's very likely you're not going to get funded.
So red flags for me is founders who haven't worked together before, founders who work part-time, founders who work in different geographic locations. I mean, even in the same city, they all work from home. That's not good. You want to work from the same shitty garage or something like that, so you can together work your way out of that shitty garage into a plush office. So really what we're looking for is, and then obviously, do they have the necessary combination of skills? Are there gaps in the skill set? So if the founders have not worked together before, the probability that this team is going to fall apart is relatively high. If the founders don't work together or are not totally committed, then the probability of conflict is extremely high. And if they can't execute because they don't have the necessary pieces in place, then the probability of them actually building something that customers want is extremely low. So those are the kind of red flags that immediately, I mean, when I see one of them, that's enough reason for me to stop talking to the company.
Interesting. And okay, so there are no red flags for a startup. It seems they're okay. But before they approach you, they're wondering, okay, how should we go about putting a valuation on our company? And also, so basic evaluations are a question that's asked frequently in Eastern Europe just because it's not talked about that much and people don't know how to think about it. So what can you do a short crash course and give them some tips?
Okay, well, we looked at deals in Turkey, for example. It's a bit like buying Turkish carpets. They'll start out at 10 times revenues, and then for us, they give us at 8 times revenues with some extra tea. But when we actually go in and structure a deal, we look at the potential, and oftentimes we put an adjustment mechanism in. We're not going to argue about what the revenue will be in a year and a half. We'll put a mechanism into the shareholder structure that after 12 to 18 months, we'll look to see what actually was achieved, and we'll make an adjustment based upon the results. And that is something that is difficult to argue with if you're actually tying into future efforts. And it's incentivizing because they can actually earn themselves equity back into the business if they outperform. And for us, it de-risks the valuation as part of the transaction.
So I like sort of rules of thumb because they sort of tend to work for me because I can make judgment calls quite quickly. And my rule of thumb is that when I look at a company that's maybe a bit later stage, so not at the very early stage, I'm going to give you a generalist formula. So you take your monthly net revenue and you multiply by 100, right? So that's a good sort of order of magnitude. If you hit, say $100,000 of monthly net revenue, then the probability that you're going to be able to raise a Series A round is relatively high, for example, because then you're sort of valuation-wise in the $10 million range, right? If you have got no revenue, then you better have a lot of users, and you can extrapolate from that users to potential future cash flows in some way or the other. And for each founder, you slap like $250,000 on top. So if you're pre-launch, you've got no traction, you've got 3 founders, worth $500,000, $750,000, $1 million, right? For every successful startup that you've done before, add another couple $1 million. Right, so it's literally how people think about it, right? Because you're saying, well, this founder is great, he's doing a seed round, it's the only time I'm ever going to be able to get into this business on the cheap, so I'm going to give him money. Yeah, there is no way to justify the valuation, right? But for everybody else, I think if you seriously, if you look at publicly listed companies and you look at their net revenue or their gross profit multipliers, that will give you some idea as to where companies that are growing really fast are valued.
I think at the earliest stages, talking valuation is very difficult. And if there is a way you can postpone that, either using mechanisms like Daniel has mentioned or in some other way, it's always a good idea because it's most of the time it's your idea against the investor idea of what the company is going to be worth and will it go places? And if it really goes places, then most likely the founder lost out. And if it's not going so many places, then it's most likely the investor lost out. I think in the earliest of stages, if you can go for convertible, and kind of postpone the negotiation on the valuation is a good idea. If you don't know what convertible kind of mechanism is, look it up. But essentially, it's kind of loan type where you agree to some sort of future results, most likely the next funding round. And if you're able to kind of perform in a year or two, then you both get a kind of reasonable deal.
So our view on it is probably different from everyone else's, which is, at Seed, we don't do convertibles. We take on risk, we price the risk, and if you don't like the price, that's it. We don't agree, right? And that's it. And so it's like you have a certain amount of equity you want to give away. We have a certain amount of equity we want. You want to raise a certain amount of money. If there is a ZOPA, is a zone of potential agreement, we'll come to terms and we'll have a deal. And if we don't, then you can try to get money from someone else. And that's perfectly fine. And the only way to kind of change that amount or change the equity or whatever is with competition. So the absolute best thing you can do for your funding round is have lots of people interested. If you don't have that, the price will be the price you get. And that's pretty much it at the early stage. You don't have a lot of choice. You don't have any leverage because investors have money and you need it. Right, so the only way to get leverage at the very, very early stage is to have lots of investors interested, because then you become the hot deal that people want to do, and it's the only way to get your price up, because there is no way to come up with a rational price. As much as Jens would like to come up with a rational price, there is no rational price for your company because you haven't actually done anything yet most of the time, and what you have done is very difficult to price. So the best advice I can give you is get competition, and even then, if you're just going for the top price, you're probably evaluating the wrong things anyway. At the early stage, investors really do make a difference, both angels and seed funds. Clearly, it's in my interest to believe that. But I do honestly believe that. And so, yes, you have to optimize for your valuation. You also have to optimize for who you want your shareholders to be. A lot of times at the seed round, it's the first time you're having someone else buy into your company, and I think you have to think about that quite seriously, right? It is your company, you own 100% of it, whoever the founders are. When you sell part of that company to someone else, you have to think very seriously about who it is you're selling that equity to, because they will be shareholders in your company for a very long time if things go well. And a lot of times I find founders who think far too much about the price and not enough about who it is they're getting into business with.
If I could just extend on that, because that's a very good point. Venture capitalists and angels and early stage funds comes in lots of different flavors. as many as ice cream, and you can get many different experiences depending upon who you pick as your shareholder. And asking and doing due diligence on us, on the money source. Are we the right fit for you? Have we invested in companies like yours? Have other companies had a positive experience working with us? We're not the top of the food chain. The entrepreneurs are at the top of the food chain. You guys create the value. Our job is to allocate capital. And we look at many deals and to try to find a relationship where we not only can invest, but we can add value by bringing corporate governance, by bringing NXT directors and adding our network and our internationalization to be more than just money in the investment. That's what our unique selling point is as a fund. And if you're looking for just money, I'm sure you'll find just money, but you'll have a very different experience in your company.
Since we have 5 more minutes to go, are there any questions so we don't end up? No? Okay. Think of some. Come on, guys. You can ask these guys how to get money from them.
Seriously? No questions. That's so sad.
These guys don't want money from you guys. It's fine. Oh, there
All right,
is.
just so you know, if there's no questions, then after the stage, you're not allowed to like come up and talk to us.
There is one.
Because you didn't really take advantage of
Is this
this.
thing on? Okay. So, how are founders supposed to fund themselves in the initial stages of the startup? I mean, I understand that you're not supposed to work, not even part-time. So how do you focus on your product while still having something to eat for lunch?
I think that's a question for me. So I'm going to ask this from a personal perspective because I founded a company myself and I didn't get paid for over a year, right? And the honest truth is I just used up all my savings. At the end, there was just like nothing left. Yeah, and just at about the time when there was nothing left and I didn't know how to pay the bills anymore, I managed to raise some funding.
Can I have a follow-up on that answer? I'm actually talking about young funders who don't have that much savings. I mean,
That's okay. You don't have many expenses either. No. Seriously though, so there's a couple of things. One, it's getting fast. It should be getting faster and faster for you to come up with the initial version of your product, right? Which is probably the best point at which you can get your initial funding. So whereas, Jens, when did you start your company? So that was 8 years ago, and it took a year before he could get paid, right? That number should be a lot lower now, right? The ability for you to get your initial MVP and even be able to show a bit of traction should be much faster now than it's ever been before. So you're not talking about spending 2 years without getting money, right? If you have an idea and you think you can build a product that can get funding, it should really be within a few months that you get. It may not be $1 million, it may be 100,000, it may be you go to Seed Camp or you go to TechStars and you get some accelerator capital, but it's just a bit of money. I mean, that's the point you're trying to get to.
I can contribute to the conversation. And successful people build successful companies. So you should kind of drop the image of 2 students in their first or second year trying to build something and think about these industry specialists or professionals with X amount of years behind them trying to build the next successful company. Chances are those guys are the ones who are going to build the next good product or the next best product and get funded by the top investors. So, you should prepare for starting your own company, either in savings, loans, 3F funding, whatever. And the difference between that is typically if you don't have experience and you don't have kind of successful track record, then probably the next venture is going to be that bit harder for you.
So another example I can give you is basically some guys who are working and they what they did is they took days off to interview potential customers. And they interviewed 40 potential customers. And of those 40 customers, 2 said, what you're building is awesome, we want to pay. Can we do that now? So they signed these 2 companies up on consulting contracts that then had the provision that if they can actually build a product that works, they would become subscribers, right? Then they quit their jobs, then they incorporated a company, they closed the contracts, and they got paid right away, right? So there is really, there's so many ways in which you can move in with mom, yeah? Mom loves you, mom is free. So there's so many ways in which you can build your startup and not have to live under the bridge, particularly now, just I mean, yeah. I don't. I think I was actually stupid back then. I shouldn't have had to spend a year actually, waiting for some cash to come in. Even back then, that was not necessary.
Okay, so with a minute and a half to go, any more questions? Okay, in the back there. Can I get a mic? The mic's coming, don't worry.
Yeah, so where? Raise your hand.
Back on the other side of the room.
Hi guys, thank you very much for sharing your knowledge with us. My name is Marius. I have just one simple question because you've been discussing a bit about accelerating grow-ups, especially most of your talk has been about grow-ups rather than startups in the very beginning. And I have just one simple question. In your evaluation process, who do you rank higher? A grow-up that has been incubated by a startup incubator, or a grow-up that has been bootstrapped, let's say, from the very beginning?
I think it really comes down to the skill sets of the entrepreneurs. I think that they can learn life skills anywhere. They can learn it from a failed previous startup, where they learned hard lessons of life on somebody else's money, or they can learn it from accelerators. I think the important thing is that as entrepreneurs, they understand that they're constantly having to learn and to grow and to keep trying again and again. And I realize that's a very American point of view, is that how many times you fail are all your success badges. But the maturity and the sophistication of the team can come many different ways. So we don't make that distinction.
Anyone else want to chime in? No? Okay, cool. That's it. Our time. Oh, one more? Okay, make it quick.
Would you fund incomplete team? Let's suppose I don't know, I miss a marketing guy, or I don't have a salesperson, but the product is good, the market looks good. Will you fund that product, that team?
Sure. I mean, that's kind of the problem with that question is it's a total absence of any actual information. I mean, yes, maybe. It doesn't really, that's not a very helpful question, I guess. It's a specific question, right? It's like, would I fund a specific team that I thought was good? If it was incomplete, yes. But there are many incomplete teams that are terrible. So, yeah.
Okay, thank you.
So you can pitch your startup after the panel. We're done. If anyone has any more questions, you can find these guys in the break. Thank you very much. Please, a big applause for my panelists.
Thank you, Ivan.